Why Vanguard just quietly deployed $4.7 trillion. Not announced, not debated, not explained. While markets stayed calm and headlines focused elsewhere, one of the largest financial shifts in modern history was already underway. Quietly, deliberately, out of sight. It was called routine. It was labeled boring. But the same explanation was used every time before systems changed forever. This movement has appeared before, only a few times in recorded history. Each time it came before confidence collapsed, not after. Each time the public was distracted while institutions prepared. And today the pattern has returned. Because when the smartest capital in the world moves silently, it is never for comfort. It is for survival. What they saw is not in the headlines. What they saw is not discussed openly. And once it becomes obvious, it is already too late. Welcome to Hidden Currency. If you've lived long enough to see cycles repeat, bubbles inflate, and promises quietly rewritten, then this channel is for you. Not for noise, not for excitement, but for understanding. If you believe experience matters more than headlines, take a moment and subscribe. Not for urgency, but for clarity. And before we continue, share where you're watching from. Geography matters more than most people realize in what's coming next. They did not ring a bell, there was no press conference. No emergency meeting broadcast on financial television. Yet in December 2025, while markets appeared calm and households focused on year-end routines, something unusual happened beneath the surface of global finance. Vanguard quietly repositioned approximately $4.7 trillion. It was not a single dramatic transaction. It was a coordinated shift, slow, deliberate, and nearly invisible to anyone not trained to look for it. To the public, the explanation was simple. Financial headlines described it as routine year-end rebalancing, portfolio maintenance, standard institutional behavior. Nothing new, nothing alarming. But history suggests that when movements of this scale are dismissed as routine, it is precisely when attention should sharpen. Vanguard is not a hedge fund chasing short-term opportunity. It does not speculate aggressively or react emotionally to headlines. It manages retirement capital, teacher pensions, public employees' savings, long-term institutional money designed to survive decades, not quarters. This kind of capital does not move without reason. It moves only when risk assumptions change. What made this moment different was not just the size of the repositioning, but the timing. Global equity markets were near record highs. Corporate earnings were strong. Artificial intelligence investments dominated capital flows. Economic data, at least on the surface, appeared stable. This was not a crisis environment. Yet the largest and most conservative asset managers were quietly reducing exposure to risk. Vanguard was not alone. Other major institutions followed similar paths, including the largest asset managers, public pension systems, and sovereign funds. Their actions shared a common logic: reduce growth exposure, increase defensive positioning, and lower overall portfolio volatility, even if it meant accepting lower returns. This behavior raised a critical question. Why would institutions built to maximize long-term returns deliberately step away from the strongest performing assets during a period of apparent prosperity? The answer does not lie in short-term market forecasts. It lies in structural risk. Professional capital does not fear volatility alone. It fears breakdowns, moments when models fail, correlations converge, and liquidity disappears. These moments are rare, but when they arrive, they rewrite decades of accumulated wealth in months. What institutions monitor closely is not market sentiment, but system stability. By late 2025, several warning signals were becoming difficult to ignore. Government debt levels had reached historic extremes. Interest costs were accelerating faster than revenue growth. Central banks were trapped between inflation control and financial stability. Each policy choice carried consequences that could not be easily reversed. At the same time, asset valuations, particularly in the largest technology stocks, had reached levels where future returns were mathematically constrained. Even modest disruptions could trigger disproportionate losses. For institutions managing trillions, this combination creates a dangerous asymmetry. Upside becomes limited, downside becomes systemic. That is when capital begins to move quietly. The public often imagines financial crises as sudden events, crashes, panics, dramatic headlines. In reality, most crises begin with calm. They begin when professionals act early, long before the narrative shifts. By the time the story reaches the front page, the positioning is already complete. Vanguard's repositioning was not designed to make headlines. It was designed to preserve capital through uncertainty. The language used internally reflected this shift: risk reduction, defensive allocation, structural caution. These are not words associated with optimism. History shows that similar institutional behavior has appeared before major economic transitions. In each case, the public explanation minimized significance, while professional capital prepared for instability. The pattern repeats, not because history copies itself, but because incentives remain unchanged. When debt grows faster than productivity, When financial promises exceed real output, and when confidence becomes more important than collateral, systems enter a fragile state. They can continue functioning for years, but only as long as trust remains intact. Institutional investors understand this. They do not wait for confirmation. They respond to probabilities. By December 2025, the probability of disruption had risen enough to justify action. The movement of $4.7 trillion was not an opinion. It was a signal. And signals like this do not appear without consequence. They were not reacting to headlines. They were reacting to history. When institutions like Vanguard reposition capital, they are not asking what will happen next quarter. They are asking a different question. Where are we in the cycle? This question does not come from forecasting models or economic optimism. It comes from pattern study, long-term cross-generational analysis of how financial systems behave under pressure. Every modern economy believes it is unique. Different technologies, different political systems, different tools. Yet when institutional researchers strip away the surface details, they observe something uncomfortable. Monetary systems behave in consistent ways, regardless of era. The names change, the tools evolve. The pattern does not. This is why large institutions maintain historical research teams. Their job is not to predict markets, but to recognize structural phases. These phases unfold slowly, often invisibly, until suddenly they accelerate. The pattern begins with stability. In the early phase, money represents real value. Growth is tied to productivity. Debt grows slowly, trust builds naturally, risk-taking is rewarded because the system has margin for error. This phase can last decades, sometimes longer. It creates confidence, not reckless confidence, but functional trust. Then comes expansion. Governments discover that growth can be accelerated through borrowing. Initially, this works. Debt finances infrastructure, innovation, and national ambition. Living standards rise. Asset prices increase. Citizens feel wealthier. The success reinforces the behavior. Borrowing becomes normalized. At this stage, warning signs are subtle. Deficits are explained as temporary. Central banks are trusted to manage balance. The system still appears healthy. But the mathematics begin to change. Debt compounds, obligations grow faster than revenue. Each new solution requires more borrowing than the last. Political pressure makes spending cuts difficult. Raising taxes becomes unpopular. So policymakers choose the least visible option, monetary expansion. This is the transition institutions monitor most closely. Because once debt servicing becomes structurally dependent on low interest rates and continuous liquidity, the system loses flexibility, policy choices narrow. Every response creates a new dependency. The economy becomes sensitive, not to shocks alone, but to confidence itself. This is when professional capital becomes cautious. At this stage, growth still exists. Markets can continue rising, innovation continues. But the system's resilience declines. It no longer absorbs stress, it amplifies it. Institutions do not wait for collapse. They act when optionality disappears. By late 2025, several indicators suggested the system had entered this fragile phase. Government debt had reached levels where interest payments alone rivaled core public spending. Central banks faced a conflict: fight inflation aggressively and risk destabilizing debt markets, or protect debt markets and allow purchasing power to erode. Neither choice restores balance. From an institutional perspective, this is not ideology. It is arithmetic. When a system relies on confidence more than collateral, stability becomes conditional. It depends on belief. And belief, once questioned, changes faster than any economic model can adjust. This is why institutions study previous monetary breakdowns, not to compare outcomes, but to recognize positioning behavior. Before past transitions, the same pattern appeared. Professional capital reduced exposure to growth. Long-duration promises became less attractive. Real assets and defensive structures gained preference. Liquidity was valued, not for opportunity, but for survival. The public rarely notices these shifts because they happen quietly. They are buried in allocation tables, policy updates, and technical language, but their meaning is consistent. When capital that does not need to move chooses to move, it is responding to rising structural risk. Importantly, institutions are not predicting disaster. They are managing asymmetry. When upside becomes limited and downside becomes systemic, preservation overtakes ambition. This is what makes the December repositioning significant. It occurred not during recession, not during panic, but during confidence. That is the moment when signals matter most. History shows that late-stage systems often feel strongest just before constraints become visible. Asset prices peak not when fundamentals collapse, but when flexibility disappears. For young entrepreneurs and business leaders, this distinction is critical. Prosperity can coexist with fragility. Strong earnings do not guarantee system stability. Innovation does not neutralize debt dynamics. Institutions understand this. They do not debate narratives. They adjust exposure. The repositioning was not a message to markets. It was a response to structure. And once structure changes, outcomes become less about prediction and more about inevitability. The pattern does not announce itself loudly. It reveals itself through behavior. And by the time the public begins asking why, the positioning is already complete. The most dangerous moment in any financial system is not when problems appear. It is when speed replaces scale. Large systems rarely collapse because of one mistake. They collapse because accumulated stress reaches a point where reactions become faster than control. Institutions understand this distinction well. Size can be managed, velocity cannot. For decades, the global financial system expanded gradually. Debt increased, markets deepened, and complexity grew. Each layer made the system appear stronger, more instruments, more liquidity, more safeguards. But complexity has a hidden cost. It creates interdependence. Interdependence increases speed. In a highly connected system, decisions no longer happen in isolation. A policy change in one area forces reactions elsewhere. A shift in rates affects currencies. Currencies affect trade. Trade affects employment. Employment affects political pressure. Political pressure reshapes policy again. Feedback loops tighten. At a certain point, the system stops absorbing shocks and starts transmitting them. This is the phase institutional analysts fear most. In late-stage systems, stability depends not on fundamentals alone, but on coordination. Markets assume that central banks will respond correctly. Governments assume markets will remain orderly. Investors assume liquidity will always be available. Each assumption depends on the other's holding. This works until one breaks. The danger is not a single failure. It is cascading response. In earlier stages of economic cycles, time exists. Policymakers can pause, institutions can adjust, businesses can adapt. In late stages, time compresses. Decisions must be made quickly, often with incomplete information. Mistakes multiply. This is why professional capital focuses on liquidity and optionality during these phases, not because opportunity disappears, but because reaction speed matters more than strategy. By 2025, several signs suggested acceleration risk was increasing. Interest rates had risen faster than expected. Debt servicing costs adjusted immediately, not gradually. Fiscal planning horizons shortened. Political debate intensified. Markets became sensitive to language rather than data. A single sentence from a policymaker could move billions within minutes. This is not normal market behavior. It is a sign of fragility. In stable systems, markets respond to earnings, productivity, and long-term growth. In fragile systems, markets respond to signals of reassurance. Confidence becomes a resource that must be constantly replenished. Institutions recognize this transition because it changes how risk behaves. Volatility no longer reflects uncertainty alone. It reflects fear of coordination failure. At this stage, traditional diversification weakens. Assets that once moved independently begin moving together. Correlations rise. Safe assumptions break. What protected portfolios in the past stops working. This is why late-stage risk cannot be hedged easily. It must be avoided. The repositioning seen in late 2025 reflected this understanding. Institutions were not abandoning growth because they believed growth would end tomorrow. They were reducing exposure because they recognized that when disruption comes, it would arrive quickly. Speed changes everything. In past monetary transitions, collapse was not evenly distributed over time. It accelerated. Years of gradual decline were followed by months of extreme adjustment. Systems appeared functional until suddenly they were not. This is not because problems were hidden. It is because systems can tolerate imbalance longer than expected, and then not at all. For entrepreneurs and business leaders, this phase creates a unique risk. Planning based on linear assumptions fails. Cash flow disruptions arrive without warning. Credit conditions tighten suddenly. Demand shifts rapidly. Contracts become uncertain. Pricing loses reliability. Those prepared for slow change are often the most exposed to fast change. Institutions protect themselves by shortening duration, increasing flexibility, and reducing reliance on external promises. They assume that access to capital may change overnight. They prepare for scenarios where response time matters more than foresight. This is why warnings at this stage do not come as forecasts. They come as behavior. Capital becomes conservative not because optimism disappears, but because margin for error does. The public often misinterprets this. Defensive positioning is seen as pessimism. In reality, it is realism under compression. Systems under stress do not break politely. They break asymmetrically. Some sectors remain functional while others seize up. Some assets retain value while others lose liquidity entirely. Speed determines who adapts and who reacts too late. By reducing exposure early, institutions buy time. Time to observe. Time to respond. Time to survive volatility without being forced into decisions. This is the quiet advantage of professional capital. They understand that in late-stage systems, the question is no longer what will grow, but what will still function when pressure accelerates. And once acceleration begins, it does not wait for consensus. By the time signals become obvious, they are no longer useful. This is the principle that separates institutional decision-making from public reaction. Large investors do not wait for confirmation in headlines or consensus among commentators. They act when probabilities shift, not when outcomes are visible. The repositioning discussed earlier was not an endpoint. It was an early response. For business leaders and entrepreneurs, the value of understanding this signal lies not in copying institutional portfolios, but in adjusting assumptions. Late-stage systems require different thinking. Most business planning is built on continuity, stable access to credit, predictable demand, reliable pricing, gradual change. These assumptions work well during long expansion phases. They fail during transition phases. The institutions reduced exposure because they recognized that continuity was no longer guaranteed. This does not mean collapse is imminent. It means fragility has increased. In fragile systems, small shocks cause outsized reactions. Planning must shift from optimization to resilience. Resilience is not defensive fear. It is strategic positioning. The first adjustment is time horizon. In stable systems, long-term commitments are rewarded. In fragile systems, flexibility becomes valuable. Long contracts, fixed pricing, and high leverage increase vulnerability when conditions change quickly. Professional capital shortens duration for this reason. Not because the future disappears, but because adaptability matters more than precision. The second adjustment is dependency awareness. Many businesses rely on assumptions they do not control: credit availability, supply chains, currency stability, or continuous demand growth. These dependencies feel invisible during calm periods. Under stress, they surface abruptly. Institutions map dependencies carefully. They ask what fails first if conditions tighten: liquidity, customers, suppliers, financing. Entrepreneurs rarely ask these questions early. Those who do gain an advantage. The third adjustment is balance sheet discipline. In late-stage systems, leverage amplifies speed. Growth funded by debt works until it does not. When financing conditions change, leverage structures lose optionality. This is why institutions accept lower returns in exchange for lower volatility during these phases. Survival preserves opportunity. Forced liquidation destroys it. For individuals and businesses, the lesson is similar. Preserving control is more important than maximizing expansion. The fourth adjustment is signal interpretation. Public narratives often lag reality. Media explanations focus on comfort. Complexity is simplified. Risk is normalized. Institutions, by contrast, observe behavior. They track flows, not opinions, allocations, not statements. When conservative capital moves defensively during prosperity, it signals that expected returns no longer justify embedded risk. This is not pessimism. It is probability management. The final adjustment is psychological. Late-stage systems test discipline. They reward patience, not excitement. They punish overconfidence. The most dangerous belief during these periods is that past success guarantees future stability. History shows that transitions rarely look dramatic at first. They look boring, technical, easy to ignore, until speed increases. The repositioning was quiet because it needed to be. Institutions do not warn publicly. They do not debate. They reposition and move on. For decision makers paying attention, the message is clear. This phase is not about predicting collapse. It is about recognizing reduced margin for error. Growth still exists, opportunity still exists, but the tolerance for mistakes shrinks. Those who understand this adjust early. They strengthen liquidity, reduce unnecessary leverage, diversify exposure, preserve optionality. They prepare for faster change rather than bigger change. Those who dismiss the signal often do so because conditions still feel normal. That is always the case before transitions accelerate. The system does not announce phase changes. It reveals them through behavior. The question is not whether history will repeat exactly. It never does. The question is whether incentives, mathematics, and human behavior still apply. They do. Institutions acted because the structure changed. For business leaders and entrepreneurs, the opportunity lies in seeing what they saw, not copying their moves, but understanding their reasoning. In periods like this, the greatest risk is not caution. It is assuming that tomorrow will look like yesterday. The repositioning was not a conclusion. It was an opening signal. Those who recognize it early gain time. Those who ignore it lose flexibility. And in late-stage systems, flexibility determines survival.